Hey everybody, Brian Shannon here from alphatrends.net. Today's Friday, the 18th of September 2015, and the market's closed with some losses this week. Keep in mind, all these numbers are not adjusted for dividends. In the S&P 500, the spiders did pay a dividend today of $1.03, I think it was. Anyways, we had a lot of volatility, obviously. So let's just go ahead and take a look right at the charts and make some sense of this all. The S&P 500, as we saw, got up beyond the prior band of support in here, this little prior band of support. It had been acting as resistance, and on Wednesday we closed above it. Thursday we saw that the rally continued a little bit until after the Federal Reserve, and I had noted earlier in the week that what's known as the pre-Fed drift is a very common phenomenon that the market will often continue to move higher before the Federal Reserve announcement. Now, this is a study that the FOMC did themselves. It's a 64-page PDF that you can Google. Just do pre-Fed drift, and it'll pop up. Anyways, it's been known to happen, and it did here once again this week. That is, continue to drift higher ahead of the Fed. So on Tuesday, we saw that the market began that rally Wednesday and then Thursday. And I was saying on Tuesday or Wednesday that as I pointed that chart out, that it's my little conspiracy theory, basically, that they do this. They, maybe the plunge protection team, whoever. But the point is that the market runs up in front of these events often, so as to build a little bit of a cushion, so that they're far enough away from a major level of support that even if it breaks down, it won't do major damage. Let's take a look at where we ended up. So if we take a look at this 15-minute chart, you can see that this blue line, that's the volume weighted average price since the August 24th low. So it appears as though we did come back down to a very important level. We've also got this as a prior level of not only resistance over here a couple times, but support as well near that 194. So perhaps we drift down a little bit further next week. We had, when we look at the daily time frame, we broke beyond that level, and we were also looking at some other things such as the volume weighted average price since the high here, and that was right around this level since this little peak. Here's the volume weighted average price. So the market is still undergoing a lot of gyrations since that price shock. And on the bigger time frame, we do still have a broken market. And if you look objectively at this, it really looks like that we've seen this is our return move and that we should head another leg lower. Each stock obviously should be traded on its own merits based on what that stock is doing. That's what I say all the time. Here's a little trend line that I think kind of represents the essence of this recent recovery, and you can see we closed below that. So for next week, I would say that this market remains guilty till proven innocent as long as it's below 198. If it can get back above 198, it becomes more neutral, but 198 is now the level under which, if you see rallies, do not trust them for anything more than a day trade. I'll be out all next week in Alaska, and I won't have an internet. At least I hope that I don't. I'm going to bring my computer because I'm a junkie, but I hope the internet doesn't work there. Anyways, so today obviously we saw the deeper retracement, and if we take a look at something else that I had mentioned was the Fibonacci level, that is the retracement. So from this peak, for instance, to that low, or we could take just even the entire range for the year 2015. That's our low to high, or high to low rather. So here's our high up in this level from, I guess that was May, and then the recent low. So what we see is that the market dropped that much, and then it rallied up, and this is a 2/3 retracement, so 61.8%. That's often what's known as the golden mean, or the the Fibonacci, the golden mean, basically. But anyways, as it applies to stocks, it is considered that anything beyond a 61.8% retracement is considered a reversal. So we found resistance in that area. We also found resistance with a declining 50-day moving average. As I say all the time, the direction of the 50-day moving average, if we are rallying and we've got a declining 50-day moving average, do not expect that those rallies will continue to hold. So the Nasdaq, for its part, kind of interesting here too. If we take a look at the year-to-date chart, here's the year-to-date volume weighted average price, and you can see see we closed 2 days above that, but then gap below it here today. So that's just kind of interesting because that had to, it had it been able to hold above that level, which was also this prior band of support, then perhaps this market would have been signaling that a bigger recovery is possible. I think though that right now you have to look at this market still is guilty till proven innocent. It broke beyond this band of resistance and then came back down into it. It's also below that 5-day moving average. Here's a bigger potential band of support. And if we take a look at since the event, since the August 24th low, I think that this will be an important level next week in here near about the 103.5 level. So we've got a market with a declining 50-day moving average where we just found some sellers as well. And the best case scenario is that maybe we continue down into this area in the next week or so, and then rebuild for some further strength. But again, this is just not a good looking chart. This is classic technical analysis 101. Support broken tends to act as resistance, and now that we have all these moving we're below all these moving averages, you have to look at it as if we're not beginning a longer term downtrend, then we're going to undergo a correction through time that is going to take a while before we return to a environment where the buyers can control the trends for more than a couple weeks at the most. And so for that reason, you've got to be very cautious. We've got earnings coming up in a few weeks, and those could be catalysts that maybe turn this thing around. But right now, you have to look at all these markets as guilty till proven innocent. They are in primary downtrends. We've got a declining 50, 100, 150, and 200-day moving average in the Russell 2000. The Russell 2000, the volume weighted average price since the event, is down here at about 114, 113 and 3/4 to 114 basically. That would be a level I wouldn't want to see breached next week. And if it does, it doesn't mean you sell short below it, because how does it get there? Let's say it drops to 114 on Monday. I sure wouldn't sell it short, but I would be looking for maybe if it was to get down there, rally, and then decline again, then to look to short it. But right now, this market is trying to recover, but it's very unconvincing. There's nothing to be optimistic here. This had been a previous level of big resistance and then support, and now it's showing us that it is in fact acting as resistance again here, and tells us that it's kind of foolish to be looking at this as something that you want to put money in for the long term until you get the opportunity for this market to straighten itself out. And that doesn't happen while we have a declining 50-day moving average. Semiconductors finished out below that 50-day moving average. So again, they came up to it, they came through it and down, and now excuse me, back below it once again. And here's another case that when we have a declining 50-day moving average, you don't want to be the person who's buying it, especially when we have this prior band of support over here. So the semiconductors have been broken. They've got the declining 50, 100, 150, and 200-day moving average. That tells you that institutional money is in net outflow. Why on earth would you want to fight them unless you're going to do it for the shorter term? And now that we've had this big bounce, it leaves it susceptible to a bigger decline as well. So for the semiconductors, we can look at, again, the volume weighted average price since the event, right down near about 49. So I think that this is what we want to see hold next week, 49 to 49 and a quarter. I personally won't care because I won't be here, but if you're interested in seeing this market begin to show some firming up, you would want to see that hold. We broke the trend line. We're below the declining 5-day moving average. I'd say that this is the new level, that if we remain below $51 a share in the semiconductors, then they remain guilty till proven innocent. The biotech stocks, I had been telling people that I thought, this is a group that we might want to keep a closer eye on for potential weakness because it's one that Janet Yellen has called overvalued before. I miscolored it there, but it was actually up 0.5% this week, the biotech. So, but you have to say, does it look like they can continue? We have this prior band of support here. We came right up to the declining 50-day moving average. We can also take a look at the volume weighted average price since the peak, and that's what this line represents. And you can see we're right at that basically. So here, let's draw that again on this time frame. We're just below it actually. So the sellers since that peak have been in control. Now year to date, of course, it's had a bigger run, but we're still kind of flirting with the volume weighted average price year to date, meaning that on average the biotech market adjusted for volume has traded right here about this 350 level, and above it basically there's a lot of people who on average are making money but not much, and they can't be feeling good about it. But breaking back below and taking control could see the next leg unravel, and I would say 340 is a potential level of support, and then we have about 332 as well. Back to that 10-minute chart, the 15-minute chart rather, the volume weighted average price since the low, that'll be an important level to hold next week. That's about 343. But you have to be looking at this market with a high level of suspicion. You have to ask yourself before you enter any stock or any ETF, where has it come from? So after, let's say on Thursday, where had it come from? It had come from this horrific decline of 285 up to 360. Where did it have so it expended a lot of energy getting there. Where did it have the potential to go before it was likely to encounter supply that would slow it down? That's the prior support. That's the declining 50-day moving average. That's also the volume weighted average price since the peak. So the risk reward is what you have to determine before you get into the stock, and determine whether it makes sense for you personally. If you're a scalper, you can always look at a 1-minute chart and find an opportunity in there. But for the average person who, most people should not be trading that aggressively. For those average people, and I don't mean the average person, not that those people are average. The people who don't day trade in a skilled and disciplined way, you have to look at it and say the risk reward just simply is not worth it up here. Let's take a look at Apple. Apple, as we know, we've been monitoring the volume weighted average price since that last earnings report, and we had spent a couple days above it. We closed right around that level today, and we also saw that this prior little band of this little area in here, actually, let's remove this one because that's actually not as important. But we broke a downtrend line a couple weeks ago. We got back above the 5-day moving average and the volume weighted average price since the event, but we came back down again today, and look where we are. We're below that declining 50-day moving average, and for when we're below a declining 50-day moving average, you do not expect that rallies will continue to hold. I wouldn't be surprised to see another leg lower in Apple. I wanted to talk about Alibaba real quick too. It's interesting that Alibaba had a negative Barron's report, front cover. They said that the stock could decline 50% from here. So last week, basically it was unchanged for the week. This is where it closed a week ago, Friday. It gapped down, and we basically closed only slightly lower. You don't have to read Barron's to know that there's a problem with Alibaba. You can listen to Alpha Trends, or you can listen to Alpha Trends, interpret the price action, which has been saying guilty till proven innocent for the last 8 months. You can do that yourself with very simple tools. I teach those tools in a class. Anyways, I don't even want to talk about that because I got to go pack. I'm going to Alaska, and I'll talk to you guys maybe next week. I kind of doubt it.